Hey guys, welcome back to the channel. In today's video, we're going to be talking about liquidity pools. And obviously, guys, this video is for entertainment purposes only and shouldn't be taken as financial advice. A liquidity pool is an area within the market where smart money, like banks and institutions, are looking to hunt retail stop losses in order to fill their very large orders. You want to think of them as obvious entry areas for retail traders. Think support and resistance, round number price points, or key lows. To break this down even further, let's imagine this rectangle is a key level of support on the daily timeframe. You can imagine that many retail traders will be looking to place buy orders at this area. This means that there will be an abundance of stop loss orders placed just below this area, which we will visualize using this red line. Remember, a stop loss order is really a pending order in the opposite direction of your trade. So what we really have indicated with this red line is a big cluster of retail sell orders. What's important to remember here is that big players like institutional traders are looking to place massive orders which require a lot of liquidity, which in a nutshell means to place this big buy order requires a lot of people looking to sell, aka those retail stop loss orders. And because smart money has entered at a lower price, they're getting a discount on their buy order. This is why you'll often see huge wicks form at obvious levels of support and resistance, and also why you've likely had the unfortunate experience of getting stopped out early in many more obvious trades. The good news is that once you're able to spot liquidity pools, you might be able to avoid getting prematurely stopped out of these type of trades. Here are a few tips to help you find them. First, look for more obvious support and resistance levels, especially at higher time frames. Remember that support and resistance can also occur at trend lines or any other obvious pattern formation. Next, you want to look for areas with a lot of volume and sharp price reversals. You'll see long-bodied candles forming, pushing aggressively into our area of interest. It's not uncommon for this to occur after a ranging period where price is essentially trapped between two price points, like the one pictured here. In theory, the longer this range goes on, the more orders become stacked at this level, the more liquidity becomes available for institutional traders. Eventually, you'll see a strong impulse that moves aggressively through that obvious key level. This will normally result in a long wick followed by a quick and sharp reversal. In theory, this is smart money collecting those retail stop loss orders discussed earlier. Okay, let's look at a real-life example. And here we're going to look at gold on the daily time frame. Up until this point, we can see that price has respected this area indicated as a level of resistance. We can see here that price has been in a fairly strong uptrend for the last couple of months. We can also see where we've highlighted here with this rectangle that there were a few weeks where price did consolidate between that ranging period. Remember that we haven't seen a manipulation candle yet. Within this consolidating period, more and more orders are stacking up, and we need to wait for that initial breakout move before we can look for entry. The manipulation candle we're looking for is going to have a long wick indicating a lot of indecision, and it's going to break out of that range with a lot of momentum. Ideally, after that long wick forms, you do want to see price close back within that range and period. Just to help you visualize this further, a typical retail entry would be at this resistance zone we pictured earlier that I've highlighted again here. Smart money theory supports entry once that manipulation has occurred and you've confirmed that the trade entry is valid. Like most effective strategies, trading liquidity pools is more effective when trading with the trend. An easy hack to find the overall trend is to place the 200 EMA on your chart. If price is trading above the EMA, it's in an uptrend, and if it's trading below the EMA, it's in a downtrend. So this particular example we're looking at would actually be a bit riskier. The more distance between the EMA and price, the stronger the trend. And here's the most underrated tip. Don't chase the liquidity pool. These moves can happen really quickly, and you still want to confirm that the entry is valid. So if you miss it, just sit it out. The next tip is to make sure that you place your stop loss outside of the liquidity pool and not within it, in case price comes back to that area. Remember that liquidity pools are more likely to form where there is a ton of volume, so understanding volume oscillators can be helpful in identifying areas of interest. When looking to confirm entry after a liquidity grab, you'll want to watch for a shift in market structure. A break of structure confirms the move, and to get a more accurate entry, do this on the lower time frames, like the 15-minute and 5-minute chart. And that about wraps up this video, guys. If you want more examples of spotting liquidity pools or how to trade them, please let us know in the comments below. And don't forget to subscribe for more content.